the risk in these markets is really, I suppose, shown through the FX lens, and this is a nice display, isn't it? Recession back in 2009. This is the 3-month implied volatility for dollar sterling. We're at the highest level since 2010. But look at this; it's practically vertical here. It's gone off a scale. But look, it could have an awful lot more to come. Will we see a lot more risk in sterling assets?
At Eaton Vance, we believe we will. I mean, as you mentioned, sterling assets, we've started to see that volatility creep in, but it hasn't actually moved much. It's mostly been confined to the FX market where we've seen that. And we think what's clear is that both the Leave and the Stay campaign will focus on fear, and the next 3 months will be very much fear-based pandering to people to figure out which way they should vote. The Leave campaign, very concerned about if we stay in the European Union, what does that mean for migrant crisis? What does that mean for the flow of people? What does that mean for UK sovereignty? While the Stay campaign will focus on the fears around, well, if we leave, what does that mean for
the great unknowns, the job losses potentially here. But from a positioning point of view, and this is what I'm trying to get an understanding of, I understand the FX story. I understand that the 3-month 25 delta put skew, is shifting, that everybody's positioning through FX. But gilts and equities, as I said to Michael Metcalf, the UK market is one of the best performing markets, equity markets, in Western Europe. Take me through the high yield, take me through the bond market perspective, because the gilt market, which is obviously the differential upon which we benchmark all of your bonds, has seen very little movement.
I would agree with that. And
very little fear. Sorry, let me correct that.
That is the case. If you look, again, mainly confined to the FX, in terms of individual bond movement, first thing to note is that sterling bonds only account for around 3.5% of the global high-yield market. So it is a relatively low portion. We have seen some technical weakness, but certainly not the type of weakness we've seen in the FX market, and certainly not the type of weakness that we would expect if we do go down the path and that uncertainty increases. And I think the one thing that fear brings is uncertainty, and uncertainty eventually will lead to further weakness in these assets. So in the Eaton Vance Global High Yield strategy, we have been reducing our sterling exposure, and as we move closer to the referendum date, we believe these risks are going to be increased, and it won't just stay confined to the FX markets, but it will actually move into sterling asset weakness.
One of the, obviously we touched on it slightly in terms of the ECB, but this reach for yield and negative rates and the move by the ECB, how is that going to rebalance itself as we're in the portfolios for you?
Yeah, obviously this is the sort of thing that we are concerned about in our global mandates, exactly where we want to be positioned in our high-yield strategies. What we need to focus on is what does it actually mean? And if you look at the Fed, obviously you alluded to some of the more hawkish comments that have come out recently. I think there is an understanding there that as inflation rises, and we saw core inflation above 2% for the 3rd month in a row last month, we're starting to see that momentum is picking up, and that the Fed most likely wants to move.
You said most likely wants to move. I mean, what is the theory within Eaton Vance? I mean, we're seeing these voices shift really from the most dovish Fed announcement in a century, according to Goldman Sachs last week, to lacquer, to a whole host of voices, not least Bullard last night, shifting the dial. And it's down to this inflation perspective. How many do you think that they'll do this year?
Yeah, when you look at the rhetoric, it is very different depending on which party you're looking at. If you listen to Yellen's press conference after the announcement last week, she was alluding to the fact that, yes, inflation is higher, but we need to see more of that coming through. Yes, we have reached the employment targets we're looking for and are closer to full employment, but she also recognized that we can't view this in just a vacuum. No. We need to be cognizant of global risk. We need to be cognizant of what other central banks are doing, and I think that divergence in monetary policy is actually something that's more difficult to achieve than first thought.
Jeff, always great to get the input from Eaton Vance here on Countdown. Jeff Muller, the Global High Yield Portfolio Manager.